Welcome back to Investing Talk Podcast.
Today, we are counting down the top 5 stocks to buy right now, based on our latest research.
This is a big one. Before we get to our first pick, be sure to subscribe, like, and comment to support the show.
Yeah, definitely do that.
And if there's a specific company you want us to look into, just leave it in the comments below.
All right, let's start the countdown. What's the first company on our list?
First up is Celestica.
Okay, Celestica.
Yeah. The reason it's standing out is, well, the absolutely stunning fundamental performance. I mean, really.
Okay, tell me more. What kind of numbers are we talking?
Well, revenue for the trailing 12 months, TTM, stands at $11.28 billion.
$11 billion. Wow.
And their 2024 revenue increased by, get this, 21.17% to $9.65 billion.
Okay, solid top-line growth. But what about profit?
That's the kicker. Net income surged by 75.12% to $428 million for the same period.
75%. Whoa. That's huge leverage. Revenue up 20, net income up 75.
Exactly. It screams margin expansion, efficiency, maybe pricing power. And analysts, they're noticing.
I bet. Confidence must be high.
Oh, yeah. EPS estimates for 2024 moved up 33.2% over the past year. Big upward revisions.
So the market's definitely catching on to the story. What about the technicals? Does the chart agree?
It does. Technically, the stock is trading well above both its 50-day and 200-day simple moving averages.
Right, the classic momentum indicators. Above the 200-day is key for that long-term bullish trend.
Absolutely. Confirmed strong bullish momentum. Very little resistance, technically speaking.
Interesting. Okay, so Celestica's got strong fundamentals, analyst confidence, and technical momentum. Solid start.
Definitely.
Moving on, my pick for the next one is Webull Corporation.
Ah, Webull, the brokerage space.
Exactly. This one is all about, well, explosive growth in the retail brokerage space.
Explosive growth in such a competitive market.
Yeah, look at their Q2 2025 revenue. It grew 46% year over year. 46%. Reached $131.5 million.
Wow. Okay. That is impressive growth. Are they profitable?
They are. Confirmed sustained profitability with a TTM net income of $77.55 million.
So what's driving that kind of growth against giants like Robinhood?
What's fascinating here is their expansion strategy. It's really key.
Expansion. Where are they going?
They recently gained entry into the European market, specifically via the Netherlands.
Europe. Okay. So diversifying beyond the U.S. and Asia?
Precisely. It's setting the stage for major international growth, tapping into underserved markets, planting flags,
That makes sense. Gives them a buffer. So what are analysts saying? Are they buying this story?
They are extremely bullish. The consensus price target suggests over 90% upside potential.
90% upside. That's a strong conviction call.
It really is. It suggests analysts believe they can really execute on grabbing that international market share.
Okay, Webull. High growth, international play, strong analyst backing. Very different from Celestica.
Very different. Now, where we go next?
Next up, we shift gears again. We're going into space infrastructure and defense with Redwire Corp.
Redwire. Okay, space and defense. So government contracts, that kind of thing.
Exactly. We're looking at a company with a massive contracted backlog, $355.6 million as of Q3 2025.
$355 million. That provides immense stability, right? Revenue visibility.
Huge stability, especially in the space sector. You know that cash flow is theoretically locked in if they execute.
But isn't that sector known for being pretty volatile? And didn't they adjust guidance recently? How much insulation does that backlog really provide?
That's a fair point, definitely a critical question. The argument is that the quality of the backlog matters.
Okay, quality health.
Well, they are key suppliers for really high-profile projects. Think contracts for Axiom Space's first commercial space station module.
I mean, that's significant.
And deliveries of advanced UAVs, drones to defense agencies like the U.S. Army. Mission-critical stuff.
Right, things that aren't easily canceled. Yeah. So are they actually turning that backlog into revenue effectively?
It looks like it. What's critical is the acceleration in their top line recently. Q3 2025 revenues were $103.4 million. That's up 50.7% year over year.
At 50% growth. Okay, that's strong execution.
And importantly, they expanded their gross margin significantly, too. It was 27.1% as of Q3.
Better margins suggest they're getting more efficient at delivering these complex systems. That helps offset the contract lumpiness, maybe.
That seems to be the idea. So if we connect this to the bigger picture, analyst average targets are still exceptionally high.
Even with the volatility?
Yeah, ranging from like $15.43 up to $16.83. Suggests the focus is really on that long-term, high-margin contracted revenue.
Okay, so Redwire is a bet on stable, long-term government and commercial space contracts despite sector volatility.
Got it. Right. High stakes, high growth potential there.
That raises an important question, though, given the high volatility in that sector. Let's maybe dial up the risk even more.
Uh-oh. Where are we going now?
Let's look at Phemysis, a micro-cap stock in women's health.
Microcap. Okay, so definitely higher risk. Women's health. Interesting niche.
Yeah, this is a very high-risk, high-reward kind of choice. Definitely speculative.
So what's the bullish thesis here? What makes it worth the risk?
It really centers on their impressive revenue acceleration. They saw 52% growth in 2024, up to $1.63 million.
52% growth is strong for a small company, but $1.63 million is still tiny revenue.
It is, but it's about the potential of their proprietary portfolio. They have devices like Phemyseed and FemView.
What do those do?
They're involved in reproductive health, intratubal insemination, fallopian tube diagnostics, potentially disruptive technologies, not just small improvements.
Disruptive. Okay. And are they making money on these yet? Margins?
Well, they have strong gross margins, actually over 65%, which is good. It signals high value. But,
Sure.
and this is a big but.
You come the risks.
Exactly. They have high leverage. Their debt-to-equity ratio is, well, it's 403.4%.
Whoa, 400%.
Yeah.
That's extremely high leverage. And they're still losing money, right?
Oh, yeah. Ongoing net losses. TTM net income is negative $21.02 million. They're pouring money into R&D and getting these products to market.
So that high debt ratio means any stumble could be really bad. Dilution risk is huge.
Massive risk. It's a high-wire act, absolutely. But the market seems to believe they're hitting an inflection point.
An inflection point where revenue starts covering those costs.
That's the bet. The conviction seems strong, reflected in analyst consensus price targets averaging $7.33. That's way above where it's trading now.
So analysts are betting heavily on successful execution and maybe some binary events like trial results or approval.
Exactly. Confidence in the growth roadmap. There's a potential catalyst coming up, the Q3 earnings report expected November 13, 2025. That'll be a big tell.
Okay, Phemysis. Very high risk, potentially high reward. Depends entirely on execution and hitting that inflection point. Definitely not for the faint of heart.
Not at all. A completely different risk profile.
All right, finally, let's round out our top 5. What's the last pick?
Last one is Open Door Technologies.
Open Door. Back to a larger company, but in a tough space right now, iBuying.
Right. This stock requires patience, definitely.
Right.
But it offers significant recovery potential. They are the clear market leader among iBuyers.
The biggest digital home transaction platform in the U.S., but that whole model got hammered by rising interest rates, didn't it? Inventory costs must have been brutal.
Absolutely brutal. So why is it a potential buy now? It comes down to a strategic move they made.
Okay, what did they do?
They recently completed a large equity issuance, over 180 million shares.
Equity issuance, a dilution for existing shareholders.
Yes, there was dilution, but it significantly boosted liquidity, gave them a big cash cushion.
Ah, so it was about survival and having dry powder.
Exactly. Allows them to weather the housing downturn and, crucially, accelerate investment in their technology and marketing, especially the tech.
The tech being their pricing algorithms, that's key in iBuying, right?
Absolutely critical. They're AI-driven pricing. If they can make that even slightly more accurate, it has huge implications for profitability down the line. They're using this downturn to sharpen that edge.
Okay, so the bet is they survive the downturn, improve their tech, and are positioned to lead when the market recovers. But they're still losing money now.
Still reporting ongoing losses, yeah. TTM net income is around negative $317 million. The hope is those losses narrow as the market stabilizes and their tech improves margins.
And what about the chart? Any signs of life there?
Technically, yeah. The stock is actually well above its 200-day moving average. It seems positioned for a potential relief rally if, and it's an if, the housing market stabilizes or they announce significant AI upgrades.
So it's a long-term play on the digitalization of real estate transactions, led by the market leader who's fortified their balance sheet. Needs patience?
Patience is key. It's a bet on market normalization plus that technology mode.
So to recap, our 5 stocks to watch are Celestica, Weibull Corporation, Redwire Corp, Phemysis, and Open Door Technologies. Quite a range there.
A solid list covering different sectors and risk profiles. As always, though, please do your own research before making any investment decisions. This is just our analysis of the current data.
Absolutely essential. Thanks for tuning in.